Alrighty. So in today's video, I have a special request video from you guys, and that is to cover GameStop, right? So GameStop has been in the news recently. The market has shot up, then it came back down. I've had quite a number of people that, have asked me, hey, Davis, can you cover GameStop? Can you talk about some option strategies to trade on GameStop? And that is why I decided to create this video. Now, I want to say that I do not trade GameStop. I think that there are better stocks out there, better, underlyings out there to trade than GameStop. With that said, if I were to trade GameStop, this is how I would trade it. So first of all, the very first thing I want to do whenever I'm trading any individual stock is to find out, what is this company that I'm trading, right? Because each stock that you're trading is actually a company. So the first thing I want to find out, is this a fundamentally good stock, right? So one of the ways that I like to find out whether it's a fundamentally good stock or not is to take a look at the financials for the past 5 years, right? To see whether it's actually making money. So as you can see down here, GameStop has not been making money, right? You can see that the revenue is quite inconsistent, and the only thing that is consistent is that it has been losing money, right? It has been losing money for about 5 years straight. So 2024 hasn't exactly ended. We're not sure how it's going to pan out, but just by looking at this, you know that chances are that it probably could lose money as well. So this is not one of those stocks that I would categorize as fundamentally good stock. And for me, this is important to classify, because if it's a fundamentally good stock, then I might want to trade it for a longer term, certain strategies that I want to apply to it as well as compared to other stocks, right? So for GameStop, it's not one of them. So I will have more of a kind of strategy whereby I may just trade it a few times, but not one that I'll regularly keep on putting on, strategies over and over again. So remember, whenever we are trading options on any underlying, there are two things that needs to match with each other. So the first one is the underlying, right? You need to have an understanding of the underlying, and then you need to suit the option strategy to this underlying. That is to say that not every strategy is suitable for all types of underlying. So that is why for GameStop, I need to first understand what it is. So from here, I can kind of understand that, I may not be that biased to just only the upside. For example, if it's the fundamentally good stocks, like for example, Amazon and Google, then those are the stocks that, I may trade much more bullish strategies. But for GameStop, doesn't seem that way so far, right? So the next thing that I want to look at is the chart. I want to take a look at how the prices has been performing, recently. So as you can see down here, the market has actually been, not really doing much for, quite some time, and then all of a sudden the market shot up and then the market came back down. So straight away, this tells me that this stock seems to be very, very volatile in the sense where out of the blue, it can suddenly shoot up, right? Because this is a meme stock, right? So the reason this really shot up was because of just one person, right? So this influencer named Roaring Kitty, as you can see down here, whenever he would, tweet on this GameStop, this is where you will have this huge surge, right? So as you can see down here, his bull tweets and live streams helped drive the 2021 meme stock surge. And then recently, same thing as well. I think he talked about it, and then he went silent, right? As you can see down here, through his recent silence has coincided with a noticeable price dip for the meme stock. So down here, you can see that this stock is one of those stocks where I will consider an explosive stock, where it can just suddenly just shoot up out of the blue, right? And it seems that the risk is more to the upside rather than to the downside, because at least from what we can see down here, when the market comes down, right, during this period of time, it's not as violent as this move up here, right? It's such a huge move. So that is why, I would probably err more towards a more bullish kind of a trade, unless the market has, gone up quite a bit, right? But for now, at this current price down here, I would say this is where I would rather go more bullish rather than bearish. Now, if you were to take a look at this as well, this is a tweet by Unusual Whales. Recently, this GameStop options, right? You can see that the calls have really ballooned up in the IV, right? It has gone over 1,000%. And that really is very crazy, right? If you have something that's 1,000%, then you know that the kind of price movement is insane, right? So you can see if the price really shot up from this point down here. From $16, it shot up all the way to over $64. That is like how many times, right? I think maybe about 4 times or so, something like that. So if you happen to catch it before, you know, this big move, then of course you definitely want to get out very quickly. But at this point of time, I think the market has come down and the volatility is not that high anymore, right? So I was taking a look at the option chain, and you can see the IV on the right hand side of the option chain, right? Most option chains should actually show that. So for this, I'm using actually the Thinkorswim platform. So you can see down here, the IV is actually around 100+%. Right, it has come down from 1,000 over %, but that is not to say that this is still not high. It still can be considered, you know, high compared to, you know, some of the underlyings that I'm used to trading. Like for example, the index ETFs. Index ETFs are much lower than that. Now, the next thing that I like to look at as well is the option chain, right? I want to see how is the bid and ask spread on this option chain. So as you can see down here, the bid and ask spread at the money options, right? Let's take a look at the put down here. You can see it's about 30 cents wide, right? That is close to about 10% of the price of the bid and ask. So that is pretty substantial, right? Even down here as well, even the at the money calls, about 30 cents or so. And it could get even wider, right? Over down here, maybe about 50 cents as you go further out of the money, right? So for me, I feel that this bid and ask spread is a little bit wider than, you know, what I'm really used to. Because if I was to compare with a similar price stock, let's say for example Palantir, right? You can see the Palantir is roughly around $24 as of this recording. GameStop is around $23, so they are pretty similar. But if you were to take a look at Palantir's their bid and ask spread, all right, let's take a look at the put side. You can see that's only 2 cents wide, right? 2 cents wide out of roughly about $2. That is almost close to about 1% kind of weightage on the whole price of the bid and ask, right? So you can see it doesn't take that much. Same thing on the call as well, right? Only 3 cents. So it is considered pretty tight compared to GameStop. So what does this tell me? So this tells me that I would try and avoid trading those multi-legged strategies. And multi-legged strategies like, for example, maybe the butterfly or even the iron condor or anything that has 3 or 4 legs, right? Maybe the most that I will go for is just 2 legs, right? Preferably if you can go just for 1 leg, that's fine. Because if you were to enter and exit the trade, there'll be 2 times, right? You enter 1 time, you exit another time. You will be actually losing out quite a bit on the spread, right? So remember, when we are trading the options, not only are the commissions involved, right? If you go for a Robinhood, yes, there's no commissions, but you also have to take a look at the spread, right? So you can see that this spread is going to take quite a big chunk of your profit if you're going to make any profit, and it's going to add on to your losses as well. So as a rule of thumb, generally I do not like to trade stocks whereby the options, the bid and ask spread is pretty wide, right? Anything I think above 5 to 10% of the bid and ask spread, I think that is considered pretty wide, right? So with that said, let's try and figure out, you know, what kind of strategies we can trade on GameStop. So the next thing I also like to take a look at is the weekly chart. So I want to zoom it out to take a look at a much bigger time frame, to take a look at, you know, how the stock has been performing for a longer time, right? So this is over the past, I think about 4 to 5 years down here, right? 4 to 5 years. And you can see that over 4 to 5 years, the market looks really like a VIX chart, right? If you have taken a look at the VIX chart, it's pretty much like this. It's almost like it's mean reverting, so to speak, right? Market will go up, come down, go up, come down, and then staying low for a while, go up, and then come down again. So this is not one of those stocks, like I mentioned, like the fundamentally good stocks or the index ETFs, right? Those kind of stocks, you will find the pattern is where the market is going to keep going up, right? In those cases, you can position certain strategies more towards those kind of charting patterns. But for this GameStop, from what I can see, is that the risk really is pretty much to the upside as of this point down here, right? So let me just remove all the drawing down here. You can see in the past 4 to 5 years, the low is somewhere around here, right? Somewhere $10 to $15. That's around maybe the range, maybe even to $20. So during at this pricing, at this price down here, the risk tends to be more on the upside, because you can see that, you know, the market can shoot up like that, right? Just suddenly just have a shoot up in price much more than if the market was to go down, right? Same thing over here. So now, because the price is roughly around 23, 24 odd dollars, I would say the risk is much more to the upside. So that means I do not want to really go, where I'm playing the market to the downside. I do not want to play GameStop to the downside, because it doesn't seem like there's too much room, at least from history, right? From the historical prices. So with that said, I'm more inclined to put on bullish strategies at this current price. All right, so what are the strategies that I'll put on? So I'm going to share with you 3 bullish option strategies that you can use on GameStop at the current price. Now, before we put on any bullish option strategies, the first thing is that we want to have a setup that kind of favors our bullish option strategies. So what kind of setup do we want to look out for? So if you're just new to trading options, then I would suggest, a very simple way to identify, a better chance, at least a higher probability of the market wanting to go up than to go down. And that will be through 2 things, right? So the very first thing is to identify the oversold condition on stochastics, right? So as you can see down here, this is the stochastic indicator. What it does is that it identifies, overbought and oversold condition. If it goes above this line down here, this is where it's considered overbought, right? So usually when it's overbought, price tend to come down more often than not, and once it's oversold, the price tends to go up. Now again, I will say this in many of these videos that I talk about stochastic, is that this is not some magic indicator that every time it's oversold the market will definitely go up, or every time it's overbought the market definitely go down, right? There'll be times where it's overbought, it will continue to be overbought. If it's oversold, it will continue to be oversold. But if you were to just look at this, which one is a much more strategic point for you to enter into a bullish position? When it's oversold or when it's overbought, right? So definitely when it's oversold. So that is the first condition that we want to look out for. Now the next one is to try and identify support levels, right? So support levels are basically just prices or levels where you see that the price have kind of bounced off, right? So as you can see down here, there is 2 levels that you can look at. So the very first level at the top, you can see over here, the price kind of hesitated going up, right? There was some sort of resistance there, and as you know, there'll be times where when the resistance is broken through, it becomes support, right? So as you can see down here, it broke through and then it came back down, it found support, the market momentarily went up again. Now the market is coming down. So at this point of time, we've identified the oversold conditions, we have identified the support levels. Now we can, place our strategies more strategically, right? At least this way we will find it much more comfortable, or at least slightly more safer than if we were to randomly just place our bullish strategies on, right? So what is the very first strategy that you can consider putting on GameStop? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So the very first strategy would be a very simple one, would just be the wheel strategy, right? So the wheel strategy just consists of 2 simple strategies. Number 1, just sell the cash secured put. So the whole idea here is to get into the stocks, right? So if you are maybe also punting on the fact that maybe all of a sudden, if Roaring Kitty was to come up with one of those tweets again, the market is going to shoot up, then you could actually sell a cash secured put and then have a long position, right? So if you sell a cash secured put, let's say for example, you get filled on it, you could hold on to the stocks as well. If you hold on to the stocks, it's not going to be that big of a risk, right? Because let's say for example, if you were to sell a cash secured put below the support level, let's say roughly around $16, then what's the max you can lose, right? The max you can lose is $1,600 if GameStop goes bankrupt, right? So that's not too much on your pocket, right? Compared to, some of the much more expensive stock. Now, of course, if you find 1,600 a little bit too much, then of course, maybe this strategy is not for you. But if you were to take a look at the upside, the upside seems to be much higher, right? For example, if let's say, for example, you could actually get filled at $16 and Roaring Kitty comes up with one of those tweets again, and the market really shoots up. You can see that it shoots all the way up to about 60 plus. Then you have many times the risk that you put on for this trade. So like I said, this is where I would only go, put on bullish strategies rather than bearish strategies as of this point. So back to the wheel strategy. So after you sell the cash secured put, if you get assigned, then the next thing you want to do is to sell the covered call, because this isn't one of those stocks where you want to hold onto it forever, at least from my standpoint. Why is that so? Because this is not a fundamentally good stock, right? That means to say the earnings have not been increasing, and that also, kind of translate to the price, right? The charts, as you can see. If you take a look at Google, Amazon, all these fundamentally good stocks, you can see that the prices has just kept going up and up and up and up. So those are kind of stocks where you could consider holding on to the stocks for a longer period of time. But for GameStop, I think this is one of those hit and run, get in, get out, and then wait to see if there's any other opportunities rather than constantly put on the strategies over and over again. Now, how will you actually position the cash secured put? So I've taken a look at the option chain down here. You can see this is the put option chain. You can see down here, if you were to sell the cash secured put at 16, then you will see that the kind of amount that you will get is actually not that much, maybe about $45, right, per cash secured put. So if you think it's a little bit too little, what do you do, right? So one thing you can simply do is just wait, right? Wait for the market to actually come down a little bit lower. Once it gets closer to where the support is, then you can start to sell the cash secured put, right? You want to sell it at a strike price that maybe you feel comfortable owning, or the other way is to maybe look at the delta, right? So if you were to take a look at this, the reason why the premium is not that much, although it's actually quite a bit already for most stocks of this price, because the IV is actually pretty high, inflating the premiums. But if you want to get a little bit more premium, then you want to position at a slightly higher delta, right? So maybe if you were to go somewhere around down here, then you would see that you will get much more premiums, right? So the way to get this higher premium at the same strike price at 16 is to just wait for the market to come down, right? If the stock comes down, then you can choose to sell at $16. And then once it's assigned, then this is where you can wait until, at a suitable place that you want to get out of this stock. Now, the next strategy would be the put credit spread, right? So if you do not have enough risk to put on, let's say, for example, you feel 1,600 is a little bit too big, you want to risk something lesser, then you can go for the put credit spread, right? A put credit spread, basically, if the market goes all the way to zero, you don't have to worry because you already have this long put in place, right? This long put basically just covers the max loss on your end. So if you feel the wheel strategy is a little bit too capital intensive for you, or you do not want to put that much risk onto this trade, then you might want to consider the put credit spread, because with the put credit spread, you can go for a smaller risk, right? At the same time, you also still can have your bullish outlook. Now, the third and final strategy that you can consider putting on GameStop, and that would be the call debit spread, right? So this is also known as the bull call spread. So the call debit spread is slightly different from most of the strategies that you have seen on my channel, in a sense whereby most of the time we are receiving the credit upfront, right? We're getting paid to put on the trade. Whereas for the call debit spread, it's the opposite. You actually have to pay it out, right? So it will be a debit, you have to pay for it. And for this, I actually do like the call debit spread for GameStop, mainly because of the way it's being structured on the option chain. So before I get into that, now the first thing I want to get into is how would you get into call debit spread. So at this current price, you can just simply put it on, right? What I would do is put the at the money call debit spread. So that means you want the long call at roughly where the current market price is, right? So if the current market price is around 23.65, you could consider putting somewhere around $24. And then up here for the short call, this is where you limit your max profit. Now, it's definitely better than just buying a call outright, because if you were to buy the call outright Firstly, it's going to be a little bit expensive, right? Because theta is going to really decay your option very quickly, and also the IV is pretty high. So the best way to get into a debit kind of a position, it would be to use a spread, right? So call debit spread. So this is where you can put your short call, at a place where you think it's going to jump to, right? If you want, you can just go for $5 wide spread, $10 wide spread, or however how far you think the GameStop can go, right? So this is one option that you can put on at the moment right now. Now the other way is that you could just wait for the market to come down first, close enough to where the support is, and then you enter into the call debit spread, right? Alternatively, if you're a little bit more conservative, you can wait until the market goes down to the second support area, then you place the at the money call debit spread. Now, I kind of like the call debit spread for GameStop, and the reason is because of the structure you can get with the call debit spread. So if you were to take a look at the option chain, so let's just say you were to craft an at the money call debit spread. So maybe you go for the 24 and then you just construct it 5-point wide. You notice something that is slightly different from what you would get if you were to put on like the index ETFs, right? For example, for this down here, you notice for the at the money call debit spread, you can get a risk to reward ratio of roughly 1:4, very close, right? You can see the risk is slightly above $100, and you get very close to $400. So it's close to 1:4, which is pretty good, right? Because this is something that you cannot get on the index ETFs, like for example SPY, right? If you were to take a look at SPY right now at this current price, if you were to go for the same at the money call spread and also $5 wide, what you will notice is that the risk to reward is actually less than 1:1, right? You can see over here the risk is close to about $300 and your profit is only $200. So your risk to reward is like you're risking $1 to make roughly about 0.67 cents or something like that. And the reason it's like this is because SPY has what you call a put skew, right? If you have a put skew, then your call side is going to be not that good, right? Because you don't get the kind of risk reward. But if you were to put the put debit spread on SPY, then you will get a very similar construct as this one down here. So why is it that GameStop has this construct for the call side? And the reason is because GameStop has call skew. So basically the call are trading at a richer premium compared to the put side, right? So as you can see down here, when you construct the call debit spread, you actually have a pretty good risk to reward ratio. And also one good thing about GameStop is that occasionally, right, the market can just all of a sudden just shoot all the way to the top. So you don't risk that much whenever you're just punting on it, speculating maybe there's going to be a shoot up. And then if it does shoot up, hey, you can get a pretty good risk to reward ratio. All right, so to sum things up, at this current situation of GameStop, at least from my perspective, I think you can consider putting on these three strategies, right? So the very first strategy is the wheel strategy. So if you feel that you want to get into the shares and hold on to it for some time in case, Roaring Kitty comes up with a tweet again and the market is to shoot up, then you can use the wheel strategy. But if you don't want to put that much capital and you want to, have a lesser risk, then you can consider putting on the put credit spread, right? So with the put credit spread, you'll receive credit up front and you will have a pretty decently high win rate that is above 50%. Again, depends on where you position your put credit spread. But if you feel that, hey, you do not like the risk reward, then you can go for the third one, which is a call debit spread. So with the call debit spread, you have a slightly lower win rate. It's roughly around 50% win rate if you're going for at the money call debit spread. But the trade-off is that at least you will have a much better risk reward ratio, and it's somewhere, as you can see, as of this current price, roughly 1:4. All right, guys, so let me know in the comments below whether you like this kind of videos where I go in depth into examining what kind of option strategies you would trade for the individual stocks. So if you feel that this kind of video is helpful, let me know in the comments below, and maybe also you can let me know what kind of other stocks you would like me to examine and go through as well. And last but not least, also let me know in the comments below, of these three strategies, which one would you be more inclined to put on. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.